Hi, everybody. This is Phillip Guan, CPA. This is a class to teach you how to do tax return. It's a very fun process, and I like you to enjoy it. So this is class number 5. Okay. So on your screen, you are going to see practice number 5. We are going to learn 4 things. How to input W-2, which we know it. The child tax credit due diligence is also we learn it. It's a review. Now, what is new is the Schedule E, which is rental income, as well as unemployment compensation. Now, today, I'm not going to go back to review class 1 to 4. If you want to learn, you can go to YouTube to search my channel. It's right there. Okay. So now I am going to go to video in here, the scenario. And may I have Rudy, can you able to read this scenario?
Yes, North and Southeast are married and have one child. They are both United States citizens and live the entire year at the home in Chicago, Illinois.
Okay, well, the following is just their ID information. We don't need to read it. When we do it, we're going to highlight it. So as we go continue in here, this is the taxpayer, and this is the spouse. As you can see, not that I know of, there's a such name, there's a such a last name East, is in Northeast, is a makeup number. Okay, it's a makeup name. All those information are not any of the client information. So this is for training purpose. We take clients confidential very seriously. So that's why there's no piece of information is confidential. Okay, there's a children, there's a child. And the child is called Westies. Okay, the information is like there. And then when we come here, may I have Rudy to read this whole thing, this whole paragraph, so that when you're going to understand a little bit. Okay.
Yes, both North and South were employed during 2023 and received Form W-2S. North was unemployed for a couple of months. Therefore, he also received Form 1099-G reporting unemployment compensation. They have no interest in or authority over any foreign account and did not use virtual currency. The taxpayer owned a duplex located at 725 Windy Avenue, Chicago, Illinois. Zip code number is 60601. They occupy one half, 50%, and rent out the other half. The unit was rented for the full year. The East received $36,000 in rent and spent approximately 750 hours actively managing the property. The duplex was placed in service on January 1st, 2023 as an accelerated rental real estate property with a 27.5 years life. The basic attributable to only the rental unit portion of the duplex is $275K, not including $100K for land. The East would like to deduct the appreciation for the duplex. The East did meet all the filing requirements for filing Form 1099 for payments made in 2023. The rental does not qualify as a trade or business.
Okay. Okay, thank you. Appreciate that. Now, let me get to here. As we come to here, first thing first, we are going to do it in split screen. It makes life easier, right? Let me hide this control. Let me move this one to here. Okay, I don't need this. No, I need this. Now, there's a plus sign on the right. Move a little bit further on the right, and you hold left mouse and then pull it to the left and this half, let go. And then we choose whatever want to put it on the right side. Now, this is dependent, this is a taxpayer. We can highlight and copy. We move this one in here. Okay. Okay. So now I have worked on this clients in the tax software 2022. That's why we get all this information. So we got all the information. We can do this. Now we come here. We open the number one. Now that Mary fired Johnny. So our file option, we are doing number 2. And then we're looking for the social. They highlight it in green color. What that means is the software asks you, hey, watch it out, double check. So it is correct. You really check it. It's also correct. The client do not want to see you prepare tax return ever any misspelling of letter or any long numbers. Birthday is correct. Sometimes their occupation changes. Yeah, sometimes they may get promoted. Okay. So the spouse. Do you notice it? In this example, the husband and wife have the same birthday? Not very often.
Yes.
Not very often. In my 20+ years practice, I haven't seen one in my real client yet. So in this situation, when you see the birthday same, and you make sure you ask the client, hey, you guys have the same birthday? Is it? So they say, yeah, and then as a congratulations, well, you guys can celebrate together. But as the way you double check it, sometimes they may provide you a long information. And then by doing so, they say, no, we are not. And then you're going to ask them, hey, what's the birthday? What's the birthday? So that way you confirmed it. So in here, now, do you also notice this year's birthday, even that the month is correct, but the year they're changing the year. You see that?
Mm-hmm.
It's 1985. This was 70. So we need to change it. It matters. When you, for example, if they're age under 25, they won't be able to get earned income credit. If the age is more than 65, they also won't be able to qualify earned income credit. No. Graphic design. Oh, okay. So now their home address. Windy Avenue, Chicago. I changed it to San Francisco. Let's change it back to Chicago. 60601. Okay, so I come here. 60601. Enter. They changed them all. There's a county of Cook. they'll pop by itself. Okay. And then there's a health insurance. There's a information they will talk about the health insurance. Since I'm on this field and I'm looking for all the green, which clear the green, and now we see all the blue, see if there's anything we can really double click and into it. This is what they say. They have entire year, but they don't have, but yet they have all insurance, but in this example, they don't provide a 1065A. So it really means all you need to do is in here, you say this. And you do not, because you do not have information provided from here, like this Cover California, they maybe get the health insurance from the boss. Okay. So which you don't need to do any input. So go back to 1. Because I was in the 1, I jumped to here. So now, you remember, and then there was a place that they say there's no foreign account, as well as there is no digital currency, and which gave you a no and a no to this answer. I will go through detail last time, so we are just check the no in here. By the time when we have an example, we go to detail of this. Okay, those are important. This example doesn't have it, doesn't mean it's not important. But each and every example have their focus thing. Like today, we focus on the rental property as well as the unemployment. We haven't go through that yet. So this is the like our firm's information. And now, this is what if you prepare this client's federal tax, like line 24. Assuming I double check it is correct, okay? And then this is their California total tax. Not how much the refund is, how much the total tax on that year. Okay, so do you really need to do this? Yes, you do, because this will figure out whether or not they need to pay the estimate tax penalty or not. Okay, so far, except the ID come here, dilemma. This direct deposit or direct withdrawal, we don't do it right now because we don't know yet, and they also do not provide information. But there's an ID, and I remember like this. Let me see if I'm right. Oh. The other one is it's a makeup number, right? What state they are? I don't know. Not always like that. I just happen to this example to make it very simple, and it's very rare they have the same issue day and in the same birthday. Even in the normal state of California ID, the ending day on their birthday, they should have been like 11/25. Even it's the same thing. If it's state of California ID, they will be 11/25. What year? Like that. They're always in their birthday. Yeah. in here. They kind of make life easier for all the example like that. Okay. So we're good in here. So we finish number 1. We go to dependent. They have kids. It's called West is. Okay, let's look at West is like here. All the information is in here. Now, West is 4021212 is a daughter, 12 months. So they went to daycare. Now it's 4,450 per month for 12 months. So you cannot put the calculation. You have to double click one more time. In here, you can right click calculator 450 times 12, enter, insert, and then you get this. Now, this number, you also need to, you copy this number, you put in here, the 2441, right here. So now, the amounts, right? Right now, right? Oh, sorry. Right here. I try to move this tab. And then you want to make sure the EIN of the child right here. Hey, by the way, this is not the social of the kid. It's the provider information. The original was wrong. You see that? That was a kid's information. So it should have been like this. So this is the kid's. This is the kid's ID. And we need to input it is the provider's EIN. Whoever provide the child care. So if the company is the EIN, if the person is that social. So if this is a company. Okay. So there's only one kid, right? There, this kid, those information talking about this kid. Literally say it, it's their kid, they can claim it, it's qualified. Now, in here, we're going to close this. Oh. Go back to the child. Oh. Guess what I was doing? No wonder I was using the 2022 tax software. Can you see it? Can you see it?
Yes.
I was doing 2022 tax software. I'm going to, since I'm doing 2023, so no wonder that's so okay. Now I am going to lower it over to 2023. I just noticed. Oh, no wonder because I was working on 2023 was not here. Let me see. So let me try 2023. No wonder. I can load over the things from the current 2022 to 2023. So there are a lot of things is still carryovers. So now in here, last year data, update from here. Now, I want to update everything from what I just did. So to make life easier. Okay. This is 22, 23. I'm going to close 22. I'm going to close 22. So that way I won't get confused. I'm going to close 22. It's a good practice when you work on that thing, put the last year lock it. So that way you won't be able to change it. Don't need to still there. Let me close them all the way. Now, no more 2022. We are in 2023 now. Okay. So let's make sure the taxpayer is correct. The spouse is correct. Okay. Those information is already up there because I update after I input it. Now the ID, it should have been updated. Yeah, I do. If you want to get rid of all the front, so hold, use your left hand, hold Shift, Control, and space, and then you can get rid of more than one. And you want to make sure it's good before you do so. Okay. Now this one is the healthcare. Since we are repeating, so I'm going to do it faster. Okay. No. The ID we just did, right? The ID just did, yeah. Oh, in the originally, they don't have it. Assuming they should have it. Assuming I remember there was 6,000 something. But let's say for illustration purpose, this is only what they have. I cannot remember to be exact. Okay, this is number one. And we was on the child. Now, the 2022 and 2023 under the dependent portion, there's a little bit different. See it, look, it looks a little bit different than 2022. And you don't have questions. You don't have those questions at the first steps. Those questions, now those are not applied, so you leave it. Don't do anything. Let me see. This whole family had the same birthday. The kids also born in the same day. This example. Do you see that? November 25th. Okay, well, they could have one celebration for 3 people. Okay, now, the second tab right there, due diligence. You need to answer these questions. Otherwise, there's a lot of credit. You're not going to get it. Yes. And yes. Did we don't need to answer it because it's not nobody. How are they? Let me see. 4 years old. It's daycare. Okay. Take care of this. And then do you remember we have a daycare expenses? We need to input. $45. You can double click one more time. It's in here. You have to double click one more time. Go to this level, right click. You cannot do this calculation in first levels. 450 times 12. Equal this, insert. You go ahead to copy so that way you don't have to remember the number and then come here. You go to put this number in here first. Now, and then they don't have the second thing displayed. Okay. The kit part in two input. Number one is dependent. There are two tabs in independent, and there's also 2441. We done all of them. Okay. Those are old stuff. We learn it, right? And then we are going to go to the W2. So first, let's input some W2 first. Easy. Let's do the easy thing first. So who is the taxpayer? You go up, you point your mouse on the top. Okay, Northeast, right? Northeast is taxpayer, Northeast. So the first is Northeast, so is the taxpayer. So yeah, it looks like they work in the same company. So all this information is there, right? So this is right, this is right, this is right. So now 69512 7125 721. Okay. And I changed it to San Francisco before. So all you need to do is come here, go to the spouse, and then go back to taxpayer. Because I already changed in one. They lowered over when I was trained state of California. So I changed it to state of California from the training last year. Okay, so now this is the taxpayer. Paste down. There's a spouse. The spouse EIN number is correct. The same company. The zip code is 60623. 60623. Okay, now 165 there. And then okay. Obviously we need to do is in I don't know. I was try to pitch more than two companies. No. this one need to be changed. So purposely go to the taxpayer and go back to the spouse. You go back to now. The W2 is finished. W2 finished. Let's take care of the easy thing first, okay? The 1099G. 1099G right here. You see, when you all the way down in the middle, 99G right here. Belong to whom? North is. Well, you do not see, you point your mouse on the top. North is the taxpayer. T. EIN number 771111. Okay. Well, in your software, if you have been input the EIN for that employee, the software smart can pull everything out for you. So is 5336. It's like here. 5336. Right here. You see it? So now this person withholding not 10%, 1%. Okay. So it's $54 of tax. Now it's not enough, but it's just normally at least put in 10%, right? Okay. So now this is a photo. This is the unemployment. From state of California will be EDD in here. Now we finished all those little things. And we know we have four things to learn. W2 we're done. Child care, child tax care, due diligence, we haven't finished the due diligence yet. And we also still have Schedule E need to be done, unemployment. So let me go to do the due diligence questions. Okay, right here. Yes, yes, no. Skip, yes, yes, yes. No. We don't know they are qualified for earning income credit or not. You can always put this one in, and then if they're not qualified, you can go back to uncheck it. This software is smart enough to figure it out. If you do tax return long enough, you figure out approximately they're going to qualify earning income credit or not. But at the very beginning, you just, if they don't have kid, check the 9A. If they have kid, also B and C, check it. And the software going to let you know. 14, we skip it. The 15 always yes. In here, no, no, yes, yes, no, and these cases. So we're done with this. And then there's a second right here. Oh, is it dependent? Let me see. Is it child? Let me see if I finish this one. It's question right. Let me see. If the taxpayer due diligence. Let me make sure they answer the right thing. Now, let me double check up to now, and then we go back to Schedule E, because after I teach Schedule E, it'll be too long for you to review it. Okay. Okay. Compared to I change this one. This day. When you're not get used to you do and then go back to training. So it's easier for you to learn and make sure everything's right. Okay, unemployment. Unemployment, when you actually go to you, it's look like this. The W2 look like what I just showed you. It doesn't look like the illustration. Now, depending care, most the most they can get is up to 3,000. Even they have more than 6,000. Even they have like 5,400. The law only allow it. In the past a few years, there's only 1 or 2 years they allow more than that. The normal situation right now go back to 3,000. So this, let's go here and then go back to as a credit. The second thing is the child tax credit. When you get all this, Those credit go back to you. Now, we already get all the credit. Check here, W2 is correct. Okay, so the unemployment is correct. Title credit is correct. Thank you, correct. So now, let's go to the new things what we want to learn. It's the rental property. Okay, so now they have like here. Here's what I try to tell you. Right here. Okay, so I go to here. This is a new thing. Today we're talking about rental income. So we was working on focus on the tab number 1 under general. We only do one time. We go to the second tab is where when you show the start as well as it's in there, right? Do you remember that? So we do the show and start. Now on this tab, the second tab, income, in the left side, do you see the thing blue out is called rent and royalty income? And this is the thing that we are going to talk today. Okay. They own this building. They are put in 50% rented out and 50% for them to use. Okay. So now this is the net 50%. They're acted. So this address, let me say, get the address right here. 60601. Okay. 60601. So, and then they say this rental does not qualify for trade business, not QBI. So it's in here, like there. Do you see, like here? What is the matter of this? If they qualify for trade or business, they are going to get another 20%. And so it's a good deal. So, but in here, they are not qualified. So we put it as what the example say. Okay. They bought this house at this is the first year. Okay. Now we close this. Oh, hold on. So in here, there are 3 tabs. First is the property on the very top. Property information, which we just are working on it. There's quite a bit of information. Scroll down. Just scroll down to get it. Now, and then the far right is the last year what you have it. Because this client is a new year, new client. It's a good practice to put their last year number in here. So that way you will have a comparison. Now, it's this. Look. Went for full year. That's why I have 365 days. They received 36,000 as a rental income. Right here. It's a rental income. They spend that much time, and that's why they are already in answer the question in the property information. this, the things I highlighted is regarding about what we do for depreciation. Scroll down in here. Number 18, depreciation. And then also there's a blue box, form 4562. Double click in here. So now it's a 50%, it's already net 50%, okay, of this. They start in January 1st of 2023. That's what they say, right? Now, you read it. The basis of the rental unit is 275. So don't get confused of the language. Basically what they say, the rental portion of it is 275 as the building part of it. And there is 100K as the land. So basically it's 375K for half a building. Here's a tricky question. How much they bought for these houses? Is 375K times 2. Okay, it's 750K. So this whole house with 2 units is 750K. They use 1/2 for them to use it as a primary residence. They rent half of it out. Right now we're doing another half, which they're rented out. Okay. Now and then in here, they did meet all requirements for the 99. What they mean is, so we get this one done. This is the first year. Okay. So we just let the system works. Now this is 2023 first year, and like this is the building, and this is that. So where can you find those information? You can find the value of the building versus the value of the land from the property tax bill. From there you get the percentage and times the original purchase prices. Normally depreciation, it takes a few times for you to get it. So if you get a little bit confused from the very first time, don't worry. For example, you can go to my YouTube to listen to this one for 3 to 5 times, and then you also practice to apply it to follow me and doing it only for this portion of it. You say, oh, it's like that. Okay. So now, and then what we just did, okay, is get this one to figure out the depreciation expenses for that year. I'm going to show you the depreciation expenses schedules. So here's the depreciation schedules. Like here. I'm going to enlarge this one for you to look at it. So 275K divided by 27.5. So in your mind, 275K divided by 27.5, that should be 10K. Well, because you put in places in the first day, when you do the calculation for the first year, they not necessarily give you 10K even. For the year next, this is what next, they give you a 10K even. Because the software is including the first day, basically. That's basically what what this software does for you. You don't need to do any adjustment. Just know it. That's why many people are getting confused. How come 275K divided by 27.5 is not 10K? Because they don't calculate it as a one full year, just 1 year minus 1 day. That's basically what the software does for you. Okay. So now, what did the depreciation do for you? Is in the Schedule E, line 18, as an expenses against the income. See, look, this is the income minus this. All of a sudden, get this. Obvious, you have other expenses, which we are going to get. Okay, since we already, this is the net 50%. Therefore, you do not need to put another 50%. You do not need to put another 50% in here. That's why I put net 50%. Okay, now we are going to go back to rental. And we are going to the middle tab. That's where income and expenses. You see this 50%? When I put this 50% in here, they say this whole house, half of the house, they use it as their primary home. Okay, now, here's what they say. The foreign expenses is only for rental expenses. It's the far left. So legal fee, like that, like here. They only hire a lawyer, do something, maybe draft a rental agreement, something like that, only for the rental. So that's not need to 50%. And then repair, they also repair just for the rental to use it. Now, the supply is also, they buy supplies also for rental. For the first 3 portion of it is for rental only, so no need to do 50%. This 500, we get at 500, this 2,500, get 2,500, this 500, get 500. Now, on the other hand, the foreign information are to the whole houses. Therefore, you need to put in the middle. Let's say insurance. Insurance is for the whole house. So if you put in here, when you go to Schedule E, you are going to see the rental will be only $425. And then there is no mortgage. Show it up in here. And let's say the tax. Oh my dear, I wish this is the private tax. That would be nice. I don't know what state is going. It's only this whole house 750K, right? It says only 1,500, 1,200. I just paid my property tax bill. It was quite bad. The utility, it is. But in here, they don't have any mortgage interest in here. Let me see. So now, let's base on this. We're talking about they bought this house all full cash, no mortgage interest, which most of the situation not the cases. Okay. So in this situation, they are going to show up as a rental property like this. You have a rental property income, not half of it. This is 100%. is 100%, is 100%, half of it. Oh, I want to move it 500, 600%. Oh my dear. Depreciation. So as you can see in this situation, there will be an income, and this income will be go to here, and then all add together. We'll go into here. Now, they use a standard deduction because they don't have mortgage interest in this case scenario. Therefore, the tax is quite bad. They minus the 2 kids, minus dependent care, but this much tax, oh, they withhold a lot. So they get refund. Now, I want to show you that in the example, I want to see what it looks like. Oh, something's wrong in there. But let me show you the more realistic numbers. The rental property doesn't normally go to this way because, like, let's say if you have a property in state of California and San Francisco, the mortgage, the property tax is 1.1%. You have 750K, one half of it. Even the 1%. The property tax is not like this small. It normally go to at least about 4,000 in here. At least about 4,000 property tax. And then most of the people will have a mortgage. The mortgage, let's say, if they have 375, let's say 375 if they have 20% down. So 20% down, you're gonna get the huge mortgage in here, like this. 375. Okay. Let's say times 2 equal to this. Let's say they put 20% down. That's how much they let's say if they borrow 300 easy, okay. Let's say if they just borrow 300K for their rental portion of it. Once, let's say 7%. That's 21K. Just for the mortgage interest or the rental portion of it. So now, and then if you want to put it in a whole house, it will be this much. If they is the borrow total of 600. Okay, it's 7%. That will be 42,000. So half of it. So here's what the more realistic numbers at first, and you will see there will be a negative as a rental at the very beginning. Like this. This is the mortgage interest, half the house. Oh, the property tax more likely will be total with about at least 8,000 to 9,000 for the whole house. By doing this way, this will be more realistic as they bought the house right now if they're in the state of California. With the mortgage. Now in this situation, there's a little bit negative, and this negative is going to be offset other incomes. Their tax situation will be total difference. Now, if they are this situation like that, so the mortgage, the Schedule A, you have to calculate it and put half of it. So it become 21,000. You may need to see whether or not the Schedule A is qualified. So today, I would like to summarize what we have done. There's a husband and wife, have one kid, have a daycare, and also have unemployment. Bought a house for 2 units, 1 unit to use it by themselves, the other half of the unit for rent it out. The original example, if there's no mortgage interest, I make up a mortgage. Let's say they put 20% down and borrow 80%. Okay. And the original example, the property tax is very little. So I put it in more realistic to close to San Francisco property tax. Okay. So as you can see, at the very beginning, with the mortgage interest, property tax, and depreciation, those 3 big expenses make to this whole negative net loss a little bit. Okay. So now, I appreciate everybody's to use Friday night to attend the training. So I would like to say thank you very much and have a good night. Bye-bye.
Bye.
Bye.
Thank you. Goodbye.
Bye-bye.